Before I get started, I'd like to just say a little bit about my background. I'm the president of Comprehensive Wealth Management. I'm also the president of a certified public accounting firm in New York that specializes in working with dentists. We do work with dental practices across the country. I'm a certified financial planner, have a master's degree in taxation. I am securities licensed, insurance licensed, pretty much anything financial related. I am qualified and uniquely positioned to work with you in those areas. And we're going to jump to the final chapter of my book, which covers the time value of money. And again, just take a minute to read that quote. I do believe that's one of the most powerful quotes in my book. And I have to say, nothing could be more true than that quote. As I mentioned when we covered managing your debt, if you have an extreme amount of debt, student loans, mortgage, credit card debt, you name it, and you're paying high interest rates, the power of compounding is working against you and is going to derail you from ever becoming financially independent. If you manage your debt properly and slowly but surely start accumulating investment assets, then the power of compounding becomes your secret weapon to becoming financially independent, to becoming financially successful. And I'm going to emphasize the importance of this right now and also underscore how important time is. We've all heard the phrase that time is money. The truth is, time is money, and it's a fact. The sooner you start saving and accumulating wealth, the better your chances of accumulating a significant amount of wealth. So using the slide up on the screen right now, let's assume for a minute you're 40 years old and you got started very late in life in saving for retirement and you're planning to retire by the age of 65. So this basically gives you 25 years to accumulate some wealth. If you put away $6,000 per year, which should be very doable for most people, you could easily throw that amount or more into a retirement account depending on your age. Assuming you earn 10%, how much do you think that would accumulate to within 25 years? Well, that's the factor, and that number is $590,000. So that small effort of $6,000 per year, imagine doing that and putting it into a tax-deferred account where you're getting a tax deduction. Let's assume that you're in a 50% tax rate. You could put $6,000 into an IRA account. You'll save $3,000 in taxes immediately, but now you have $6,000 saved towards your future retirement, your point X. That is if we started at the age of 40 and only used $6,000. But let's take it back 10 years. Let's say you were smart enough to start the process at the age of 30. Same exact facts. The only difference is you started 10 years earlier, which means you put away $60,000 more. That $60,000 more, because you did it 10 years earlier, dramatically changes the factor. Now you're a millionaire. You're going to be worth $1,626,000. This is once again underscoring the importance of starting early. And let's take it a step further. Let's assume you start at age 20. At age 20, you're doing this now for 45 years. You're going to accumulate $4,313,000. Now, typically before I start this lecture, I ask the audience, how many of you think you have the ability to become a multimillionaire in your lifetime? Typically, I'll get 10% of the audience raise their hand. After I go through this slide, I ask that same question, and I'm going to ask it of you. Do you think you have it within you to become a multimillionaire within your lifetime? I'd like to think that now that I showed you this, your answer is going to be yes, but the key is starting early. The key is going to be investing your money wisely. Try to make at least 7, 8, 9, 10% or more. No guarantee you're going to do that, but you at least have to give that a shot. And be diligent about it. Continue to live within your means. Spend at least 10% less than you make. Hopefully you'll spend even less than that. And sock that money away early and maybe you could even retire instead of age 65. Maybe you could retire at the age of 50. Who knows? Anything is possible. Now, the example I gave you here was very simple, right? We're just talking about $6,000 per year. Cannot tell you how many dentists I have over the years that are putting money into 401k profit sharing plans. They're putting money into SEP IRA accounts, defined benefit plans. You could easily put away $57,000 a year. If you put away $57,000 a year into a retirement account and you're doing it in pre-tax dollars, just add a zero to that number. You'll be worth over $40 million by the time you're ready to retire. So anyone that tells you you don't have it in you to become extremely wealthy and very well off at some point in your in life, they're simply not telling you the truth. Each of you do have that ability, but you have to follow the guidance in my book, because it's not just going to happen by chance or luck. We need a plan. To further emphasize the power of compounding, I'm going to share with you a basic financial tool or term that we use. It's called the Rule of 72. This will also underscore the power of compounding and how time, along with the rate of return, is the secret to becoming extremely wealthy one day. So let's assume you could earn a 10% return on your money, as shown on the slide here. You take that 72, the number 72 divided by 10, and on average, it'll take you 7.2 years to double your money. Not so bad. Let's assume you earn 7.2%. Do the same thing, divide that by 72, and what do you get? You get 10 years. You'll double your money every 10 years. That also isn't so bad. But here's where the real problem comes in. If you're not paying attention to investing, and let's say you leave your money in a very conservative short-term bond fund, or even worse, you leave it in a savings account or money market account earning less than 1%, well, if you earn 1% on your money, divide that by 72. It'll take you 72 years to double your money if you're earning 1%. Most money market savings accounts are paying less than 0.5%. If you left your money in there, it's going to take you 144 years to double your money. So my simple point is, if I want to double my money, there's no way I can invest my money at 1%, because I'm not going to be around 72 years from now. So I'm going to invest my money in a way where I'm going to earn as much as I can, but still I'm going to do it in a way where I'm going to take only the right amount of risk that I'm comfortable with. I don't need to make 10% or 12% of my money, but it sure as hell is a lot better to make even 5% or 6% than making 1% or 0.5%. So the trick to compounding, right? The secret to financial success: start early, consistently save, and try to maximize your rate of return within your comfort level of investing. So let's take this example of the Rule of 72 a little further. I know I'm really hitting this point really hard, but I can't overemphasize how this really is the secret to financial success. So let's assume you have $25,000 saved right now, and you're only going to do that after you get rid of all your student loans. Now you have no bad debt on your books, no credit card debt. Now you finally accumulated $25,000. Let's assume for a minute you're able to generate a 10% return. Well, what's going to happen? In 7.2 years, that $25,000 will accumulate to $50,000. You just doubled your money. Here's where compounding gets exciting. 7.2 years later, that $50,000 now becomes $100,000. 7.2 years later, that $100,000 becomes $200,000. 7.2 years after that, it becomes $400,000, then $800,000, and then $1.6 million. This is real stuff here, okay? These are real numbers. It's math. That saying that Albert Einstein, I believe it was, is right on the money. It's really the secret to accumulating wealth. It's called the time value of money. And you want to either make it your best friend by saving and investing, or you can make it your worst enemy by over leveraging yourself and putting yourself into high interest, non-deductible debt, such as credit card debt. The choice is yours. It's up to you now to be disciplined enough to follow these basic rules to financial success. As I said, I am the writer of this book. It's a second edition. It's loaded with wealth of information. I would encourage each of you to pick up a copy of this book. And if you have any other questions, I left up on the screen here my contact information. It was my pleasure speaking to you guys today. I'm hopeful that you found at least one or two things that you're going to put into place immediately in your own life that will make a big difference in your life. With that said, thank you for coming, and look forward to speaking to each of you again soon.